The UK construction sector remains a market in waiting. Demand continues to be suppressed due to uncertainty in the economy, global trade tensions, and cautious investor sentiment. Recovery is also being slowed due to project delays and significant cost pressures. And yet, there are glimmers of hope. Softer inflation, improved planning approvals, and possible interest rate cuts suggest a cautiously optimistic outlook. In this update, I will be providing an overview of the macroeconomic landscape. Mike will discuss tariff impact and material cost trends. And Melissa will address labour market dynamics and contractor capacity. The UK economy grew by 0.7% in Q1, which is the strongest quarter in over a year. This has been driven by higher business investment and a one-off surge in exports ahead of anticipated US tariffs. Despite this, growth is expected to slow, with the Bank of England forecasting just over 1% GDP growth across 2025. The consumer price inflation rose to 3.5% in April, driven by energy, water, and wage costs. In response to softening economic momentum, the Bank of England cut interest rates to 4.25%, marking its third cut in 6 months. Markets expect further reduction in interest rates, though persistent inflation and global trade risk may limit the extent of rate cuts. Meanwhile, construction output held steady at 53.2 billion in Q1, marking the third consecutive quarter of stagnation, as delivery continues to be hampered by labour shortages, planning delays, and lingering uncertainty.
Tariff uncertainty is creating ripple effects across the supply chain. This is delaying projects, disrupting supply chains, and making procurement more complex, especially for imported goods. While the direct impact from recent shifts in global trade policy has so far been minimal due to the UK's domestic supply base and EU trade ties, indirect effects, such as commodity price volatility, supply chain disruption, and investor hesitancy, have been observed. Redirected supply may offer short-term relief on selected imports, offering buyers potential pricing leverage as suppliers adjust. However, this remains highly dependent on global demand patterns and how trade tensions evolve in the second half of the year. We advise clients to identify tariff exposure early, secure capped pricing with suppliers where feasible, and incorporate flexible cost adjustment mechanisms into contracts to help manage volatility and protect margins. As for materials, prices have largely stabilized, yet they remain at historically elevated levels. While current inflation is subdued, global supply issues coupled with potential surges in demand later in the year could drive prices higher. As always, collaborating closely with us is essential to secure key materials before market dynamics shift further.
Construction vacancies fell by 27% in the first 3 months of the year, signaling a slowdown in hiring as firms take a more conservative approach. Meanwhile, the workforce remains 12% smaller than in 2019, with over a third of workers aged 50 or over. This statistic raises long-term capacity concerns. Despite the softer hiring climate, wages are continuing their increase, with average weekly earnings up by 7.8% compared to last year. What has further added cost pressures is recent policy changes, such as the April rise in national insurance contributions, which has added approximately 1.25% to labour costs. So labour remains the biggest cost driver as contractors continue to pass these increases onto projects to protect their profit margins. On the supply side, contractor capacity remains tight. Many firms are tied up in long-term frameworks and being more selective about the projects they pursue. Contractor availability is improving, but largely because of weaker tender volumes and fewer projects moving to site rather than substantial improvement in capacity. Contractors are taking a defensive stance, focusing on margin protection and avoiding high-risk or complex schemes. In order to attract stronger contractor interest, we advise clients to reduce project risk early by developing tenders with clear scopes and aligning procurement strategies to evolving market conditions.
To summarise this quarter's update, here are 4 key takeaways alongside G&T's recommendations. Number 1, construction activity remains flat, with funding and viability concerns impacting potential start dates. Engaging the market early with a well-defined scope and clearly articulating requirements will help build confidence, drive appetite, thereby unlocking delivery risks. Number 2, trade and policy uncertainty continues to delay procurement activities. Understanding and communicating your project's exposure is critical, and building flexibility into contracts is key in managing this risk. Number 3, cost pressures remain high, especially regarding labour, despite softer demands. It's important to review budgets and associated programmes to ensure that they can absorb potential cost increases. And number 4, contractor capacity is easing, not due to improvements across the supplier landscape, but because fewer projects are currently progressing to site. Well-defined projects that align with contractor preferences are significantly more likely to attract interest if they are communicated early. We recommend getting in touch with us to plan early, manage risk, and shape your project clearly to stand out in a cautious and competitive market.